What do you mean by that, and what are you looking for in companies?
So classically, people might look at dividend yields for just utilities, but they're really bond substitutes. They're not growing their dividend. So we prefer companies that have the ability to grow earnings, which then allow them to grow dividends down the future. So we look for high quality companies. We focus on free cash flow, return of good return of capital, and we look for companies that are shareholder friendly, that have a record of increasing dividends. So to give you an example, at the portfolio level, we can build a portfolio of dividend stocks that's yielding about 3%. Now you compare that to something like a 10-year treasury that's yielding 2.7, but on this portfolio you can get 3% and it grows at a rate of maybe 10 to 15% a year. So we think that'll outperform easily bonds over time. And for investors who need some return or distribution out of their portfolio for retirement, that dividend yield is more certain than, say, a capital gain.
So give me an example of a stock that meets your criteria.
Okay, one stock would be Eaton. It's a diversified industrial, big into construction, both residential, non-residential, and trucking. This is a company that pays about a 2.5% dividend, but it's grown its dividend in 10 to 15% range consistently. It's relatively cheap right now, and we think as the economy recovers, they will have very good earnings power, and of course that earnings will translate into higher dividends. It's always important to pay attention to valuation on these dividend growers, by the way.
It's interesting though, because it's a cyclical company, and the fact they've still been able to consistently grow their dividends, because obviously during slower economic periods you would think that maybe that would not be the case. So it's made it a priority, the company.
It is. That's a management priority. That's something very crucial to look at.